Okay, this is going to be, I've already done one video on this, and this is number two, mining stock trading plan number two. And I'm just going to say up front that this is a pretty bad plan. But I'm going to look at it anyway. I thought it'd be interesting to, it's almost as, this is about as worse, about as bad as you can get decision making wise. So I'll just scroll down and read through it. And right there's that big word that I'm trying to avoid, panic, and sell out of the original plan when my account gets back to par. I'll explain that on the graph. Watch as I miss out on gains had I stayed in and jump in at the worst possible time. And there's a saying for that. They call it fear of missing out. And this part of the plan is not that bad. Buy more shares. It's the same as in the original first video. Mining video, let's see, what do I call this again? Mining stock trading plan number one. This was the second part of it. Buy more shares if and when the UN index drops below where I got in. And just to go over, where this is coming from, I go over to the calcs and, this is where, let's see if I can get the whole picture in there. I'm zooming out a little bit. This is where what I use to make my decisions. Originally I got in August 1999 and got out in August 2011. But here's what I'm going to describe a scenario that could have happened very easily to me, just knowing myself. Recall in the first plan, I got in there, because this thing doesn't get in at the exact low, obviously. And what I had to do is I had to watch my account. That does not look like a big move on this graph because it doesn't have a log scale. So sometimes it's useful to click the log scale on. This doesn't have it, and that way you can see that is relatively a really big move when it's down that low on the chart in essence. So my account, when I got in, I had to watch it drop. If you recall, in the first one, I got in 100,000, and I had to watch it drop to about 50,000. And then when it got up to here, what I'm saying in this plan is I just couldn't take it anymore because that happened over, I believe it was about a 2-year period that happened over. And I said, I want to get out. And I got back out, and I still had, when it hit 100,000, I said, I'm done with this. I just get out. Okay, that could have really happened. And then, I watched the gains. And I get in right here. And of course, I cannot predict these. This is the financial crisis. What this is a liquidity crisis. It's the financial crisis. It's what they call deflation. A lot of these moves here, there's another deflationary move. That discussion is for another video, maybe even another video series, because I don't want to get into the inflation versus deflation debate here. But just to suffice it to say, that's about all I can predict is from there to there. And it doesn't call the exact top, but it does get pretty close. But this down here is kind of brutal. And so I'm saying, well, what I did was I got out, and let's go back and read the plan again. And let me just erase all this. So I'm going to get in Well, I can go ahead and tell you. I'm going to get in right here with 100K. And every month that it drops, I'm going to be disciplined this time. I'm not going to panic, and I'm actually going to buy when it drops and keep buying until it gets to the point where I got in. And that point right there is happens to be 515. And I've got the numbers over here. This low point happens to be, well, I've got it right there. It's 169. Yep. So that's 169, and I've got it over there as well. And this date right here happens to be 10/25/10. 10/25/10. So, however many months are between where I got in, which is 310, this is 310.08. However many months there are there, I'm going to put in $1,000. This is not a great trading idea. I mean, you're probably saying to yourself, this is the worst case scenario. You know, you got $100,000 and you wait till right there and you throw it all in. Probably if you'd waited that long, you would have not put the whole 100,000 in. You would have maybe put 50,000 in, maybe half of it, or you would have noticed that you know you're most of the way. You can kind of predict you kind of know where that's going to go to, not exactly, but you have an idea of where this is going to go to, and you notice you're most of the way there, but you still want to pick up on the profit. And you didn't anticipate this, but you really do believe, you'd have to believe in this uh, general pattern in order to buy going down. So I'm assuming that you do believe that. So that's the plan right there. So not 50, but 100,000 and 1,000. With you had 100,000 saved up, so you still got it here. Years later, you probably had more, but uh, you and then you put 1,000 in. Now, a better idea would be conservative and put 3,000 in or something, and just buy down and buy on the way up. Maybe we'll have time to look at that, but let's just go over and look at what the results of this are. Let me erase that. Okay. So again, we got in. This is the high point right here, almost the high. 618 is just a little bit short of the high. So that's where we're getting out, and we got in there, so it's a real easy calc. That's 515 right there. You can see the 500 right there. And so our profit, there's the date we got in. Here's our profit, and it's not much, and it's over 3.5 years. Okay, so at 515, we do notice that it's dropping, and at the point at which it increases past 515, we call that right there, and we stop buying at that point. And this is, like I said, 169, and this 346 is just the difference there. And if you rather than try and calculate 1,000 each time, come up with an average of where it's going to hit in, and that average is 400. So that way I just have to make one calc. So the amount of months is 32 months. So if I'm going to do 1,000 each month, basically I'm going to get in at 32,000, and I'm going to get in at an average price of 400. and it's going to go to 618, and then that's going to give me 49,440, and there's my doing the worst possible thing. I've still managed to get an average of 8.2% per year, and this is doing the absolute worst thing that I could possibly do. And real quick, I think I got the time. What if, you know, I mean, let's just make that a little bit better. If you recall from the first video, we got 100%. It's about 110, 101%, I think it was. With that one where we did the 100,000, and then we only bought while it dipped, and of course we got to ride that gain out, and our gain was 100% per year, which is way better than anything you could have got. 8.2 is even better than what you could have got back in that time period. Probably the most you could have got was 4 or 5%. I think if you bought like a bond or something, maybe you would have got that much. You can't even get that much now. So, just real quick, this is quick enough. It might get out. I might put this one out there if it's not too long. Instead of doing 100,000, what if you did? And let's assume, let's just assume 2,500. You went in with 2,500. That was the point you decided to get in. You know, it's 310.08, but you did it all down here rather than up here. So that's zero right there. And since you're going in, you're going in right here, but you're not throwing $100,000 down right off the bat. You're throwing $3,000 down, and so 3,000 times 32. That's about 100,000, close enough. So let's just type it in. That's pretty close to 100,000. Let's see. What if I put 3,200? Well, you wouldn't have known how many months it was going to last. So that seems like a reasonable assumption. It just coincidentally came close to 100,000. So our initial starting point is 94586, literally 94586, and that is going to be better because the other one was 8% per year. This is 15.7. It's double basically. So you basically double by. If you're this late to the party, don't go all in. Just for, I hate to say what I've done, but it might look like I'm bragging, but I did not get in at the low because it didn't tell me there. But I tried to get in at this low, and I got partway in, and I got in by the time. I got a lot of it in there by then, but I remember when there was that little drop right there, my account did drop below the point where I'd gotten in. So I had to experience that on a very small scale. Let's see, get back to the eraser. And the only other thing I'll add is, like I said, this is a very bad trading plan. And I wanted to address, what you do right there. There's not much you can do about that. But I do want to address in the next video, I'm not going to do it here, but address what the difference is between this point and this point, there is quite a big difference. This is the highest the Huey had ever been. Here's the lowest. So if we use a rule of thumb, 10 years looking back, here's our risk is this era, and let's see, this is what I'll talk about in the next video. And our reward at that point, our reward would have been this, right? We already know that. Now, here, that's where we're at right now. And, you look back, and what's the lowest you could have gone? It's right there. So your risk is that much. Now, your reward is, I've got it already in there from the last video. It's even higher than that, but let's just call it 950. So 500 to 600, 700, 800, 900. I'm gonna try to draw it on here. So 500, 600, 700 would be somewhere there. 800, 900, 950. And that's if you believe that that's where it's going to. I'll do this in a future video. So this is future video, maybe the next one, because we're still doing mining stock plans. Eventually, I want to get to this point and then try to come up with a good plan. It's good to come up with some bad plans so you know what to not do. Here is a deflationary, quote unquote, deflationary move, and we've kind of already had it. But if we were to have another one, I wouldn't expect it to be bigger than that. In this one, you notice it didn't go all the way down here, but relative, all we need to do is this hasn't happened yet, but you can see that the risk, the reward. So what I could do is I could say this is reward and this is risk, and this is, so reward, compare this ratio, reward, I'll just type it out, reward divided by risk at this point is much, much higher than it is here. Here it's it's like 500% or something if you put it in percent. That's like and here it's fractional. It's like I think that would be less than 1% right there. So the ratio of this one to this one would tell you how big of a difference this point is from this point right here. And I think that the reason mining stocks are so low right now is people have this big move, this deflationary thing that they're afraid of is what's holding this back. But as that fear subsides, this thing, and people start to realize this thing's going to take off, then it's going to move up to, my theory is 950. So that's a kind of a glimpse at the next video. I'll quantify all that. Here I just showed it graphically. That's enough. Let's see if that's not too long. And if it's not, I'll post it. Thanks for watching.